Welcome to today's Learn at Lunch webinar on Canola Prospects, and good afternoon, everyone. Today's speaker is Trent Milacek, West Area Economist. If you have questions during the webinar, feel free to ask them in the chat box. Click the chat button at the bottom of the screen to open the chat box and enter your questions. We have additional resources on the eFarm Management website, and I will share the link in the chat box. Previous webinars may also be found on the OSU Ag Econ YouTube channel. I will turn it over to you now, Trent.
All righty, guys. Thanks for having me on today. We're going to talk. All I really hope for you to gain today is to think that I actually thought about canola for a little while and give you some of my thoughts on the budgets. You know, there are some positive things coming out of canola markets right now, kind of driven by bull seed markets and in general prices increasing and some good options as far as pricing next year's crop. Usually we don't think about doing that this early, and we'll get into why, but a little bit of positivity, which usually at this time of year we don't have in canola markets. So that's a good thing. Like I said, I'll talk some about input costs, but not a whole lot's changed over the past few years as it comes to producing canola. All right, so one of the big things I've been watching and is quite interesting to me when we talk about fertilizer as an input cost for canola budgets. And kind of as you see here, this red line represents 2020. And it's cruising around here somewhere around $410 a ton for diammonium phosphate, or 1846 if you're more familiar with the number side of phosphorus fertilizers. So haven't really seen these prices being lower, being translated into local prices, which is interesting. But overall, considering where we were in 2019 and 2018, where we've got fertilizer prices kind of trending at this 5-year average on this dotted line up above 480, we're a good $50 back from that per ton. So that's a good thing. And these prices tend to come, this is put out by DTN, these tend to come from up in the I-State. So it may not necessarily transfer down to us, but it is something to watch. We do see fertilizer prices staying rather low throughout 2018. We take a look at urea or nitrogen 4600. Again, a little bit lower, but not overall that much different than this 5-year average here. So just some interesting things to look at. We're tracking pretty close to where we were in 2018 as far as urea prices. Again, it might not necessarily translate into lower prices locally. You just got to kind of price around and see what your local offerings are giving you. But something to consider, we definitely don't want to skimp on fertilizer this year, with fertilizer prices generally being at or below where they were a year ago. We can definitely spend a little more money on fertility if we need to, which again, with canola, it's not going to be a crop that responds well to reduced management. We're definitely going to have to be prepared to spend money in order to make this crop grow. So just keep that in mind if we're looking at cash flows or what our needs are going to be looking further into the year. So again, according to Resquin DTN, this is a look at all the different available sources. He's seeing anhydrous being 21% lower, 1152 if that's more popular in your area, 20% lower, 19% lower for 1846, 4600 being 70% lower than a year ago, and so on and so forth. Our liquids aren't nearly as low as some of the other offerings, and 1034 liquid being only 3% lower. But across the board, lower fertilizer prices, which is a good thing. Okay. So looking at canola prices, again, this is off the ICE exchange. So we're looking at Canadian dollars per ton. So kind of getting this back to U.S. prices is a little bit difficult to get in your mind when you're looking at $520, $512 per ton there. But just keep in mind the trend here, and that's kind of what I want to focus on. And as you can see, through the month of September, we've just seen a steady increase in canola prices here, and really strong support from our 10-day moving average, which is that orange line. I would say support now lying somewhere around this 512 area, but we have traded way above where we've been throughout the past year. This chart goes back to October 19. So thinking about the last high we saw being back at 500 here, we're $20 a ton higher than our most recent top, and that would be considered a little bit of support there. Our 50-day moving average at 488. So this market is kind of just rocketing up, and there's not going to be a whole lot sitting out here to give us an idea of when we should be pricing this crop. Should we just wait till next year when we get closer to harvest? Normally, we don't forward price canola just because we see in the Southern Great Plains, we see peaks in prices around harvest time generally. So we don't do a whole lot of price protection on the canola contract, but just this is an interesting situation, interesting year with everything that's been going on with China showing up, buying a lot of soybeans. Oilseed markets are acting a little differently than we would normally expect given the time of year. And obviously you would think, being $50 a ton higher than we were back at 470, going to have a lot of opportunities here to increase that bottom line, to increase profitability canola budgets, which is absolutely required because canola budget, you'll see that it's a very expensive crop to grow, and at current prices, it can be rather challenging to make that crop make money. Looking at the past 5 years, this goes back to November of 2015. Let's take a look at our recent highs. And, I talked about we normally don't price protect because we see higher prices around harvest. Well, we got this June, July time frame here. We've got June, July in here. June, July. Of course, last year that made a liar out of all of us that tend to say that with those lower prices around June and July. So, out of 5 years, we tend to have our high prices right around harvest. So again, seeing these peaks kind of makes you think, where should we be looking at price protecting? At 520, the current price right now, of course, this is looking at July 21 contract there, but when we're looking at the 5-year average, it gives us daily nearby anyway. So going out and forward contracting or price protecting on the futures market, we're getting pretty close to those highs we saw in 17 and 18, which is good, but not necessarily great. It's certainly better than what we saw in 19. Down around 440 to 460 dollars a ton. So keep that in mind as we look at these budgets. So the budget's set up here. We have $11 per hundredweight price and 1,500 weights. Getting that back to numbers some of us are more used to. I've been seeing quite a bit of canola prices going up into the $5 range here recently. And again, with that increase in price, we've seen that take off quite a bit. Getting closer to $6 a bushel in some locations is going to be obviously a lot of help, because if you break this back, for going $5.50 to $6 per bushel, and if a 30 bushel crop, that'd be $180. Your 40 bushel crop, getting up closer to $240. So that's an important number. You think about, can I raise 40 bushel canola? Can I sell it at $6? Because with the total operating cost of this budget being at $240, that's where you start to break even. Now that number is a little deceiving, and we'll talk about why. This is just a sample budget you can get off of OSU's budget website here at agecon, okstate.edu/budgets there at the top of the screen. Some important things to think about. Seed, I like that price. Fertilizer depends on what your phosphorus requirements are. Custom harvest, it is very expensive, especially if you're windrowing the canola and picking it up. There's several operations involved there. Pesticides here, give or take, depending on what you got going on. This number can fluctuate a lot depending on insect load and what your farming practice is. Here in these sample budgets, we assume all custom work being done. So we assign a custom rate, custom value to the field work being done, planting, disking, chiseling, whatever you're doing to get that farm ready. We assign a custom value in conventional tillage. So $78.49 per acre, that would be very high for someone running older equipment that doesn't have a lot of depreciation, doesn't cost a lot to run. It could be pretty close to someone running new equipment. So keep that in mind, that's a number we're using for that. That gives us the opportunity to not worry about fixed costs. We don't have to get into the whole, how much is costing known equipment, how many acres the farmer is farming, so on and so forth. We assume if you're using custom costs that it's going to pretty much capture what it would cost a high cost individual to operate their equipment. Now, one thing that's not in here, and you probably noticed this if you're paying really close attention, is there's no land rent cost or no land ownership cost. Now, land, depending on where you are, is going to be from the survey average of $32 per acre all the way up to, if you're renting land in north central Oklahoma, you may have to pay $50 an acre. So that pushes that budget from $240 to $270 all the way up closer to $300 an acre. So again, it's very, very difficult at these current prices and with expected yields in any given year to be able to make this budget make money on top of operating costs. And again, you can argue this land rent number up or down some if you want to. You can argue about custom cost here and whether or not that needs to be higher or lower. But this set of cost up here stays pretty much the same no matter who you are, and that's got to be paid out of pocket. So Brent asked me to talk about Canola Prospects. For us to have prospects, we're going to have to continue to see this price increase and really hope for high yields. Now, there's more to growing canola than just that. We talk about the rotational benefits and the benefit to the following wheat crop, so on and so forth. I'm talking about paying bills today and what it costs to cash flow, and it's going to be a little bit difficult with this crop, so just keep that in mind. Might still find a place in some operations just due to rotation requirements, and there's always the opportunity to raise bigger crops than average. And with prices increasing the way they are, that's a good thing, but I'm not going to be overly excited about locking in any of those prices because if I'm growing this crop, I need it to go higher. I don't want to lock in 100% of my production. I may look at a portion of that this early on, but again, things to keep in mind. Just comparing that to wheat, because that's the common thing we compare it to. This is using a $4.50 price at 35 bushels and $41.80 from pasture. We are, again, with wheat, using that custom higher number, that's a little bit higher for the wheat ground. I'm not exactly sure why from the sample budget, why that's higher than the canola budget, but we'll just keep that in mind. Everything else is, again, depends on what's going on your operation. You can adjust this fertilizer cost here quite a bit depending on what your land needs. And again, we got that $32 to $50 land rent cost in there that we got to consider that isn't in this budget. But pretty much the only thing that's making wheat look better when you get right down to it is this ability to graze. Otherwise, looking at grain and average yield, there's not a whole lot of difference between the two crops. So it's not like one's beating the other in a great way. And we're talking just about grain, but if we're talking about small grain pasture, we have to definitely consider that that's another revenue source, less risk, more opportunities to pull money off of that farm. So we have to keep that in mind. With that, that's blazing through it, Brent, but that's kind of what it is. If anybody has any questions, you want to have a discussion about it, I don't know. I see Rodney jumped on here. Maybe he thinks what I do, maybe he doesn't, but be willing to answer any questions anybody has or talk about the cash flows that are required for the canola budget. But other than that, that's what I have.
Thank you, Trent. If you feel free to ask questions now if you have them about Trent's presentation in the chat box, and you can click the link at the bottom of the screen to access the chat box. I have shared the links that I mentioned previously, the eFarm Management website and the OSU AgriCon YouTube channel. A link to that, and also there's a link to the budgets page that Trent mentioned in his presentation. I will also share a link in the chat box to the survey that Trent mentioned. That helps us out a lot, knowing how we're doing and stuff and getting feedback. So yes, if you have any questions, feel free to ask them now.
Don't make it too easy on me.
It looks like they're trying to.
Trent, this is Rodney, and I'm just going to make a couple of comments in my mind anyway, that rotational benefit pretty much turns out to about equal that grazing benefit that you're looking at for wheat, which really makes these two crops almost identical from a projection standpoint if you kind of consider the next crop behind the canola. It makes them a lot more comparable, but I think that number probably is about equal to that grazing revenue that you're assuming on the wheat budget over time. If you figure you get another 8 or 10 bushel of wheat on the next year's wheat crop, that's another $45-48 depending on the price of wheat. So
yeah,
makes it kind of comparable there.
That's pretty important to mention, because in the past few years we've seen a lot of wheat not get grazed. We always, when we build budgets, we assume that people are going to be grazing it, but there's just as much wheat out there that isn't being grazed. So you got to, be fair between the two crops. You got to consider that there's going to be some wheat not grazed, and like you said, you don't grow canola without anticipating benefiting the next wheat crop by getting rid of some of your nuisance weeds. But that's the way wheat's been the last 2 or 3 years, and canola. We've planted it hoping for above average yields. And that gets back to, how do you grow above average yields? You've got to spend money. Good managers spend more money on fertilizer. They spend more money on managing that crop, more money on the right types of inputs, managing machinery costs and things like that. So again, it's kind of crossing your fingers and hoping, but that's just the way the current economics have been. And prices are getting better. We do see oil seeds increasing in price, which is going to be a positive, but you definitely have to consider the negatives of all of these crops, and that's that it's very difficult to cash flow.
I still don't see any questions yet. As always, this webinar is being recorded and it will be shared on the OSU Farm Management Facebook page. And so that will be viewable later on today. And so I will share the link to that, the Facebook page as well in the chat box. So here it is. And so if there aren't any other questions, I'd like to thank everyone for joining us today and thank Trent for presenting. And Trent just shared his email. If you do have follow-up questions for him, feel free to email him at trent.milacek@okstate.edu, and that is in the chat box as well. And we are working on scheduling our next webinars through the end of the year. I think we're going to try to do a series of outlook webinars. And so I will continue to share that information as we get more details nailed down. So thanks again, everyone, for joining us today, and we will see you in October.
Thanks, Brent.
You're welcome.